Doug Roberts, Chief Investment Strategist at Channel Capital Research, joins us right now from New Jersey. Good to have you. Thanks so much for joining in. What do you make of the comments given by the Fed chairman and the kind of impact that they have in the markets? Surely they have taken it well, but is this something that would be a medium-term positive, or this is a flash rally which will give way to some global concerns like crude or the European situation which may emerge later on?
It really depends upon the follow-through with what the chairman is saying. What we found is really when they make announcements, and these announcements are the forerunner of an extensive quantitative easing program, it's not just kind of like a one single step, but a series of steps. They tend to have a major impact on the market. We saw this with QE1. Remember, there was a de facto guarantee of the U.S. banking system which stabilized the financial situation and led to the rally in March of 2009. And that also happened in 2010 with the announcement of QE2. As a matter of fact, the current rally really started with a Fed announcement that it was going to basically extend the swap arrangements for Europe, thus offering de facto support for basically the so-called European bailouts, as well as the speech where the chairman mentioned that quantitative easing 3 was still on the board and that the Fed would use a variety of means to basically insulate the U.S. markets from European turmoil. So if this is the first in a series of steps, it could definitely be the continuation of a move. But one has to remember, it's not an economically driven move, it's a liquidity-driven move. They're just basically pumping more money into the market. This does have some effects with lowering borrowing costs for the larger companies and publicly held companies, but really doesn't get to the underlying problems within the economy.
Doug, even when there is talk of the QE3, you think what could spoil the party is still very much news flow out of Europe as well as China now?
Yeah, I think it's really more of some type of an exogenous event which causes a shock to the system. What we found is really every time there's been a slowdown, the Fed has intervened, and that has kind of mitigated the slowdown. The real danger is if all of a sudden, let's say something happens in Europe, there's a cascade effect, let's say with Portugal and Spain, that really the ECB and Germany can't seem to stop, or something occurs in China where we don't really have a tremendous amount of transparency and people start to expect the worst. Another alternative could be some type of a problem in the Mideast where there's a war that looks like it could disrupt the supply of oil around the world and thus drive the price of oil substantially. We have to remember we had a similar situation during the late 1960s, early 1970s, the age of the Nifty 50, which was derailed when basically there was the Arab oil embargo. So these are the more likely set of events, something that really the Fed loses control. Even if we look at it, it was really, the initial financial crisis in 2008 was really triggered by the bankruptcy of Lehman, which started a domino effect, which no one anticipated, and which the Fed only realized when AIG came for a bailout. And then the Fed realized that even since AIG, the trades, the regulation that occurred overseas, they really weren't aware of the situation, but once they were, they realized that essentially it could create a domino effect, which could create insolvency across Wall Street. It's really something that basically people may not be aware of that could cause the problem right now.
Okay, Doug, good speaking with you. Appreciate you taking the time out and joining in.